Hello, thank you so much for joining me on Morning Markets. We're going to get right into the major market moving catalyst. That is jobs advancing a lot more than expected in the United States. The month of November saw a job increase of nearly 200,000 net new positions as the unemployment rate unexpectedly fell to 3.7%. That's the lowest that we have seen since the summer. For some perspective on what this says about the U.S. economy and ultimately what the Fed does with this data come its next rate decision. We've got Claudia Sahm, former U.S. Federal Reserve economist, founder of Sahm Consulting, Stephen Gallagher, chief economist at Societe Generale in the Americas. Claudia, the unexpected dip in the unemployment rate, that's something you follow closely as it pertains to the Sahm rule about figuring out is there going to be a recession or not. What does that tell you?
We aren't in a recession. I mean, this across the board, this was an extremely good labor market report. And yeah, I mean, it's so the reason the Sahm really focus on the unemployment rate, it tends to start moving up even just gradually as we go into a recession. So I watch very carefully. And while one should not make too much out of 1 month, right? That was it was very much an unexpected move down. It's good news. I mean, this and the payroll gains, this shows that we are in a place where the U.S. economy could sustain this labor market. And that is excellent news.
Well, I know you were on Twitter. I watch you. I follow you. And you were basically having to explain the Sahm rule to people who were telling you, the inventor of it, that it has triggered, we're in a recession. And you were saying, no, you got to hold on. You got to look at, kind of beyond that, the quality of it. This number kind of confirms what you've been saying all along.
It absolutely confirms that the alarm bells should not have been going off last month, right? And then the Sahm rule did not trigger last month. There were some people, and I've taken some time now to really try and explain it like step by step in case it seems people want to do their own. They just don't want to just look it up. And this last month, and I was more concerned too, the unemployment rate moving up is a bad sign. And yet often, I think there are reasons why it's not bad right now, and then we're stabilizing. It came back down. So I feel very validated, and I feel very happy. I mean, I don't want a recession. And yeah, we're still on the wild ride here.
Stephen, how are you thinking about that wild ride? At least directionally, it is painting a picture of resilience. And I just mentioned, we got that consumer confidence number. People are feeling more confident at a time that inflation expectations are coming down.
Sure. I mean, I agree with Claudia. This is a good news report. You're adding the consumer expectations on top of it. Yes, all said today, it's great evidence on the economy sustaining going forward. To me, I'm still looking for a recession in mid 24. We've looked at that time period for quite some time. For me, this report is pretty close to the expectations. I didn't anticipate the drop in the unemployment rate, but we were looking for these type of job gains, these types of wages. That was another important element. And it tells us that the economy is okay for now. And you raised the question on the Fed. And the market was prematurely anticipating the Fed could be cutting rates, maybe as early as March. I think these data tell us that it's going to take some time. The Fed's watching closely, and they're encouraged by what they're seeing. No reason to adjust policy at this point.
Not to adjust policy, but Stephen, they will have a chance next week to maybe hit back at some of that market pricing in. But in the interim, we're going to get a lot of key reads of inflation. We'll get headline inflation. We'll get producer price inflation. So maybe they haven't really written yet what they're going to say. But how forcefully, Stephen, do you expect the Fed to hit back on market pricing in a possible rate cut in the spring?
Well, I think thanks to the data they got this morning, and I think the Fed's probably pretty happy with this report, they probably don't have to push back as hard because this employment report did it for them. The market's retracing, and I think it will continue to retrace some of those expectations going into next week. So it really just takes a soft push further from the Fed. I think what we'll hear is, very similar to what we saw in September in terms of their messaging. I think they'll leave open a possibility for rate cuts, but rate hikes because of inflation still being elevated, but absolutely no push behind that side of it. And in regards to the potential for rate cuts that the market had been aggressively pricing in, it's fading now, so their job is less difficult. But I think they're still going to say things like, we're not yet discussing, or we're not discussing rate cuts at this point. And I think it's just patience required. It's too early, to really be contemplating any cuts.
Claudia, is it too early to kind of declare this sort of victorious? We have managed to bring down inflation meaningfully, at the same time not tipping the U.S. economy into a recession, still growing jobs, not putting acute pain on the everyday people.
No, they're not going to do that. Oh, sorry.
Well, let's start with Claudia, and then Stephen, you can pick up on that point.
So we are not in the soft landing now. We should not be doing the victory dance. As far as I'm concerned, the soft landing's in the bag. I do not, and I have not had a recession call in this entire time. We have seen a lot of rebalancing in the U.S. economy. First, we saw it in the supply chains and the goods, and what we are watching this year is it happening in the labor market. We're moving from the shortages. We had a burst of workers coming back this year. Unemployment rate drifted up. The jobs are catching up. The job pace is still very good. There are families that have financial buffers that they have never had. If you look across income and wages and wealth and consumption, all inflation adjusted, most Americans are better off than they were before the recession. So we have an incredible amount of resilience. Now, we've had a run of bad luck too. So I don't want to be cavalier about what can be coming forward. There are risks. I think the Fed upsetting financial markets is one of them. And the other one is U.S. politics next year. So, but my base case is we're going to land this plane.
Stephen, and let's counter that with your view that we might not.
Sure. But, first, the Fed is not going to be making any victory dances at this point, but, they still remain concerned. But, we do have a mild recession forecast, and, it really is the cost of labor. I think companies are a little surprised with the drop off in the quit rate that's taking place this year, the attrition, and they're probably ending the year with probably more employees than they anticipated. The job gains that we're seeing, and by the, we had a 210 forecast for this morning, so we're not, we weren't far off in terms of, anticipating a good job number this time around. But we're seeing it in government workers, we're seeing it in healthcare. I don't think this is going to be a persistent source of job gains going through 2024. I think when we pull back from healthcare and government, what we see in this morning's report is a drop in the retail employment. It's only 38,000, but it's 38,000. And I think consumers aren't spending as much. I mean, they're showing more caution, and I think that is endemic of what's going to take place in 2024. And we should be watching that very closely.
On that note, and Stephen mentioned it, Claudia, this question is for you. The cost of labor, the wage gains, still holding firm at 4%, and some would say, that's inconsistent with getting your inflation targets down.
So we know, even going into the pandemic, that the relationship between wages and inflation is not this is not a 1-for-1, right? There can be, they can move in different ways, right? So you don't have to we don't need to see wages grow at a slower pace. I mean, I think we'll move to something potentially close to before the pandemic. We also need to keep in mind the productivity numbers, and these can be noisy, and we shouldn't, read too much into them. If productivity growth has looked really good, and that can sustain a higher wage growth. So I don't look at the wage growth, and frankly, I don't think the Fed does either, and say this is so important in what we're thinking. I mean, they are laser light focused on the CPI, frankly, the consumer price inflation, and we've seen some very positive developments in terms of it coming down. Now, I will lean into what might be read as pessimism. The Fed is going to get 2% inflation. They will not tolerate being, away from that. And if they have to, I mean, we could end up in a recession. We need that inflation to come down with what they've already done and with the disruptions, but that's not a guarantee.
All right.